A lot of people believe that you will continue to raise interest rates at incremental levels in the future. Is that because of your concern about the specter of inflation?
Senator, so where we are now is we've got unemployment at, as you know, at 4.1%, which is sort of at or near or even below most estimates of the national rate.
Don't believe those phony numbers when you hear 4.9 and 5% unemployment. The number's probably 28, 29, as high as 35. In fact, I even heard recently 42%. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down.
Today's decision to raise the federal funds rate is another step in the process of gradually scaling back monetary policy accommodation as the economic expansion continues.
It is the calm before the storm. So what did I mean by that? So I think that the peak in the market happened in February in the U.S. stock market. At that point, we had a sudden spike up in volatility. We had a big drop in the market in a very, very short period of time. Days the Dow was down 1,000 points. The U.S. dollar in January, which was, I think, part of what prompted the sell-off, the U.S. dollar had its worst January in 30 years. Now, last year was the first down year the dollar had in 5 years. Of course, when the year began, everybody was bullish on the dollar. It was the single most crowded trade. There was complete consensus of opinion among mainstream thinkers that the dollar had only one way to go, and that was up. The Fed was going to keep raising rates. The economy was going to be strong. It was kind of a no-brainer. And it was a no-brainer because the people who thought that were wrong. The dollar had its biggest decline in 14 years.
When I said it's going to be the biggest market downturn in my lifetime, I mean, that's not so strange to me. 2008, we had a problem because of too much debt. Stuart, as you well know, the debt has skyrocketed since 2008. Yep. So when I say it's going to be worse than my lifetime,
there has been recent speculation over when the stock market is expected to crash. Some financial strategists anticipate such a crash could happen in the imminent future, even as soon as 2019. According to certain financial experts, the Federal Reserve will soon have to raise interest rates in order to keep inflation under control, thus adding to the threat of recession. Just when you thought it was safe to be in the market again, the Dow Jones Industrial Average sank more than 420 points, or just under 2%, on the 24th of April. By one measure, Wall Street hasn't been this scary since the depths of the global financial panic in 2009.
We know last year, 2017, was one of the historically least volatile markets we've seen since the mid-'60s. So it's not too much to say we expect more volatility in 2018. But what we are seeing, we're really getting a lot of volatility. Here's a stat for you. 27 days so far this year have seen a 1% move either up or down on the S&P 500, only 8 last year. If you extrapolate that out a whole year, that comes out to just over 100 days with a 1% move. You got to go back to 2009, 2008, the last time we saw years with that much volatility.
So is this the end of the bull market? Most market watchers say no. In fact, only 18% of money managers surveyed by Bank of America Merrill Lynch believe that stocks have peaked. Yet the market is historically frothy after a near-record 9-year bull run. And if history teaches us anything, it's that the key to success in investing is a willingness to go against the grain. That's what those 10 well-known experts and strategists are known for, and their warnings about impending market doom shouldn't go unheeded. David Stockman. Who is he? Former budget director for the Reagan White House, former investment banker with the Solomon Brothers, former private equity investor. When to expect the worst? Imminent. There is surely a doozy just around the bend. His reasoning? Stockman expects an epic monetary and fiscal policy collision, he told CNBC. On the one hand, the recent tax cuts enacted by Congress are likely to help push the federal budget deficit to nearly $1 trillion next year. At the exact same time, the Federal Reserve is starting to unwind its sizable bond portfolio, which it amassed in the aftermath of the financial crisis to keep bond yields low to juice economy activity. The result of the Treasury Department and Fed both selling mountains of US bonds in the open market, a monumental jump in the market interest rates that will likely spook the historically frothy stock market. Yet investors seem to be in denial, he said, adding that the market is whistling past the graveyard. Scott Minerd, Global Chief Investment Officer and Chairman of Investments for Guggenheim Partners. When to expect the worst? 2019. The markets are potentially on a collision course for disaster. His reasoning: strong fiscal stimulus at the end of this business cycle, at a time when the economy is already at so-called full employment, is likely to force the Federal Reserve to step in and be more aggressive with interest rate hikes to try keep inflation in check. Minerd fears, as market rates spike, it will be that much harder for financially weak companies to meet their obligations, especially after the initial impact from the Trump tax cuts subside. Short-term rates only need to reach 3% to increase corporate defaults, according to Minerd, who expects the Fed to raise rates 4 times in 2018, probably 4 times next year. That implies short-term rates will hit 2.5% to 2.75% a year from now, and will be 3.25% to 3.5% a year after that.
So when you look at the recent inflation data that we've gotten, you look at the market expectations for rate increases this year.
Right.
What do you think we're going to hear from Jay Powell next?
Well, I think Jay Powell is going to soften us up and let us get ready for the idea that maybe there's going to be more than 3 rate increases. When you remember that the Fed was raising rates in 1987 and then was confronted with a stock market crash, that it quickly reversed course and cut rates. Or you look at 1997 when the Fed was raising rates and then we had a crisis in Asia.
Over the next year, equities will probably continue to go up as we have all these stock buybacks and free cash flow, Minerd told CNBC.
I think for the next year, even with the current tariff tantrum that we're in, that equities will probably continue to go up as we have all these stock buybacks and increased free cash flow. But ultimately, when the chickens come home to roost and we have a recession, we're going to see a lot of pressure on equities, especially as defaults rise. And I think once we reach a peak that we'll probably see a 40% retracement in equities.
Paul Tudor Jones, famed hedge fund manager and founder of the Tudor Group, he is credited for having called the October 1987 market crash. When to expect the worst? As soon as next year. We are replaying an old age storyline of financial bubbles that has been played many times before. His reasoning: we have the strongest economy in 40 years at full employment. The mood is euphoric, but it's unsustainable and comes with costs, such as bubbles in stocks and credit, Jones said in an interview with Goldman Sachs. The notoriously media-shy hedge fund billionaire believes a recession is coming in the next year or so, because the Fed took so long to raise rates to keep the economy from overheating. Inflation will follow faster than expected, Jones told his shareholders in the February letter, forcing the Fed to increase rates quicker than stated. This market's current temperament feels so much like either Japan in 1989 or the US in 1999, he told clients, according to Bloomberg. For the record, Japanese stocks slipped into an epic bear market at the beginning of 1990, and the tech bubble burst in the US in March 2000. The events that have transpired so far this January make me feel more convinced than ever of this repeating history, Tudor said. Ray Dalio, famed investor and founder of the Bridgewater Associates, the world's largest hedge fund. When to expect the worst? By 2020. I think we are in a pre-bubble stage that could go into a bubble stage. His reasoning? The chance of the US economy suffering a recession before the next presidential election is around 70%, Dalio said at a recent appearance at the Harvard Kennedy School's Institute of Politics. The influx of cash into the market, both due to Trump's tax cuts and future initiatives, like an infrastructure bill, combined with strong economy, will force the Federal Reserve to raise rates to combat inflation. That's never an easy task for the Fed. The risks of a recession in the next 18 to 24 months are rising, wrote Dalio. Keep in mind, though, that the stock market has historically anticipated recessions by 6 to 12 months, so the real selling could begin well before that.
And we're also at a point where 1937 was when the Fed said that we could tighten monetary policy. And they put a slight tightness in monetary policy. In my opinion, the risks are asymmetric on the downside. In other words, if you tighten monetary policy, certainly by more than is discounted in the market, and what's discounted in the market is a very minor rise in market, that will reverberate through asset class prices, as well as then you could have a situation in terms of the economy. So it's similar in that interest rates are close to zero, not much room on the downside, obligations are large, there is a political division, there is more populism, therefore there's more conflict, and therefore we need to be very careful at this moment. That's what I'm basically saying.
John Hussman, President, Hussman Investment Trust and well-known contrarian investor. When to expect the worst? It's anyone's guess. But when the bear does emerge from hibernation, expect a market loss on the order of 60%. Hussman has warned about a market crash for a couple of years now, as stocks valuations reach highs not seen since the year 2000, right before the dot-com bubble popped. He argues that speculation has driven investors to propel this overpriced market even higher. Blind optimism over the tax cuts has led Wall Street analysts to produce a 2019 forward earnings estimate that's 46% greater than the most recent 12-month operating earnings for the S&P 500, he said. The combination of extreme valuations and extreme earnings expectation creates a situation that's ripe for disappointment, wrote Hussman in a recent blog post on his company's website. Hussman adds that the volatility seen in the market is due more to investors becoming risk-averse, fearing a significant drop. Jim Rogers, who founded the Quantum Fund with George Soros, is on the record as saying a $68 trillion biblical collapse is poised to wipe out millions of Americans.
You know, crashes don't happen in one day. The market is going to go up for a while. I'm still optimistic about the U.S. stock market for a while, and Asian stock markets. It'll go up, and sometimes later this year or next, the decline will start in. But it doesn't happen in a day. And Stuart, when I said it's going to be the biggest market downturn in my lifetime, I mean, that's not so strange to me. 2008, we had a problem because of too much debt. Stuart, as you well know, the debt has skyrocketed since 2008.
Yeah.
So when I say it's going to be worse in my lifetime, how could it not be?
Gerald Silent is a trends forecaster who has a long history of accuracy. You can find his work at trendsresearch.com. He predicts we're forecasting the economy is not going to rebound with the economic proposals that are in place now. The global situation has created an environment for financial panic. The financial panic conditions have been in place for quite a while. What Trump's victory has done is played it off for a little bit, possibly, but on the negative side, you still have the debt and interest rates going up and the debt that has to be paid. On gold, we believe right now is near rock bottom.
The economy is not going to rebound with the economic proposals that are in place now. The global situation has created an environment for financial panic. The financial panic conditions have been in place for quite a while. What Trump's victory's done is just kind of played it off for a little bit, possibly. But again, on the negative side, with the interest rates going up and the debt that has to be paid. And so the gold, we believe right now, is near its bottom.
James Dale Davidson. He's the economist who correctly predicted the collapse of 1999 and 2007. There are 3 economic indicators screaming sell. They don't imply that a 50% collapse is looming. It's already at our doorstep.
They don't want you to know the truth. They don't want you to know that this economic recovery is a statistical illusion, that it is fueled by debt, by the printing of trillions of dollars and keeping interest rates at historic lows. This is a game of let's pretend that you are not meant to win. If everyone found out, the economic collapse will unwind. The powers that be would rather pretend that this economic monster isn't staring them in the face and breathing down their neck. The collapse is looming.
Chris Martison, an economic researcher, wrote, GDP growth is very unlikely to support the rate of credit expansion that the Federal Reserve wants, or more accurately, needs. And what will happen if it indeed doesn't? A lot of painful, awful things. But central among them is a currency crisis. And amidst the ensuing unpleasantness will be an awakening within today's hyper-financialized markets to the huge imbalance now existing between paper claims and ownership of real things. A massive wealth transfer from those with paper wealth, stocks, bonds, dollars, to those owing tangible assets, the productive value of which can't easily be inflated away, will occur, and quickly too. Andrew Smithers, an economist with an unsettling history of being prophetic, was quoted in the same article. US stocks are now about 80% overhauled. Smithers backs up his predictions using a ratio which proves that the only time in history stocks were this risky was 1929 and 1999. And we all know what happened next. Stocks fell by 89% and 50% respectively. What do you think? Personally, I'm prepping harder than ever before. I've spent too much time researching the collapse of Venezuela to sit idly by and let my family face the same hunger and desperation that is rampant there. Right now, a few rocks are falling, warning of an imminent disaster. But if you aren't prepped, you still have time. If you wait until an avalanche begins, it will be unstoppable. You will have waited too long. My suggestions are: reduce your expenses to the bone. The less monthly overhead you have, the longer you can live on your savings. Start building an emergency fund. The rainy day may be here sooner than you think. Stockpile food, OTC medications, and other necessities. Get prepared to protect your family when the economy declines. Crime increases. We've been in decline for years. Our national debt has reached monstrous proportions. Even if Trump is able to pull off a miracle and turn things around, there will have to be drastic cuts for this to happen, painful ones. People will suffer. And I'll do everything I can to protect my family before that happens.